Good afternoon, everyone, and thank you for joining us for our first webinar of 2026, the 5 things brokers need to know for the year ahead. My name is Kimberly Maisie, and I am the State Manager and Senior Financial Lines Underwriter in South Australia. And alongside me today are 2 Berkeley underwriting superstars, Matt Armstrong, who is located in our Sydney office, and Emily Meddings, who is located in our Brisbane office. We, being underwriters, insurers, know brokers are juggling multiple competing priorities every single day. That's exactly why we've designed this session to be practical, relevant, and immediately useful. So you walk away with insights you can apply straight into your conversations with clients and into your daily interactions with insurers. Today, we're going to explore the key trends transforming the insurance market, the emerging risks we're already seeing in 2026, and importantly, how you can turn these into opportunities to deliver more value. We'll also look at strategies to help you stay relevant in a competitive landscape and how enhancing your submission quality can accelerate speed and improve your outcomes with insurers, because really at the end of the day, all we want is a quick response. Am I right? So, before we start the session today, I'd like to cover a few housekeeping topics. Today's webinar will be recorded and the link will be sent to you in the next couple of days. Alternatively, it will be on our website by the end of this week. During the session, we do invite your comments and questions, so please select the Q&A section on your screen. If we don't respond to your questions throughout the webinar, we will do so at the very end. Time permitting, however, if restricted with timing, your local BR underwriter will reach out to you. If you are having issues with sound, please try to disconnect and reconnect or use the call-in number provided in the audio options on your screen. If you cannot see the presentation, please make sure you are using the WebEx app and not a browser, or you are outside your company server. And in regards to CPD and CIP points, a certificate will also be emailed to you within 24 to 48 hours, and you can claim these points online on either the NEBA or ANZIIF websites. Moving over to the agenda, we hope that by the end of today's webinar, you'll be able to recognise the biggest trends shaping today's insurance market, spot emerging risks early, and understand what they mean for your clients. Apply strategies to remain relevant and deeply valuable in a competitive market, and strengthen your submissions so you get faster responses and better results. This webinar is especially important for brokers who want to stay ahead of the market shift, identify new opportunities, and enhance their relationships with both clients and insurers. So let's start by looking at the broader landscape, because 2026 is bringing significant shifts that every broker needs to be across. From what our underwriting teams are seeing, combined with what's happening across the global insurance market, several structural trends are reshaping how risks are assessed, how capacity is deployed, and what your clients are expecting. Firstly, we're seeing tighter underwriting capacity and a renewed focus on discipline. After several hard market years, pricing momentum is easing, but insurers are becoming even more selective about where capacity goes. Underwriters are doubling down on data quality, risk selection, and documentation, all in response to softer pricing conditions and rising operational complexity. This means that the quality and completeness of broker submissions matter more now than ever. Secondly, regulatory and governance pressures continue to intensify. Across multiple markets, there's greater scrutiny on disclosure, compliance, AI adoption, and capital standards, which does flow directly into underwriting expectations. Insurers need cleaner information, stronger governance, and better documented client risk narratives. So for brokers, this places even more importance on guiding your clients early and ensuring submissions are accurate and compliant. Third, client expectations are rising sharply. Clients want more than just a policy. They want the speed, the clarity, digital convenience, and advice that's tailored and proactive. Their expectations are being shaped by broader digital experiences, and the insurance sector is not immune to this shift. So brokers who anticipate their needs, communicate proactively, and bring insight, not just the quotes, will stand out from the crowd. We're also seeing major external forces shaping risk and coverage demand, including cyber escalation, geopolitical volatility, and an uptick in litigation severity. Cyber risk continues to grow rapidly with ransomware, deepfake fraud, and supply chain cyber incidents. Meanwhile, tariffs, inflation, and global supply chain pressures are influencing claims costs and the pricing models. And finally, technology and talent pressures are transforming underwriting and distribution. AI is now affecting real underwriting workflows, which is enabling speed and consistency where data foundations are strong, but amplifying talent and governance challenges where they are not. The brokers who are going to succeed this year will be the ones who stay ahead of these market shifts, not react after the fact. Engage their clients early and provide insight-driven advice, deliver high-quality, well-structured submissions, and act as a strategic partner rather than a transactional intermediary. This year rewards those who are early, prepared, and able to bring genuine insight to their clients and to their market. I'm now going to pass you over to Matt Armstrong, who will discuss the emerging risks shaping the 2026 landscape.
Thanks, Kimberly. So as most of you are aware, there's several which is not just emerging risks any longer, and moving into 2026, there are definitely emerging risks that are shaping the insurer's appetite and underwriters' approaches, ours included, and need to be conversations for brokers to have with their clients. What is interesting is the exposures often sit outside the insured's direct controls, but they do have commercial consequences when they fall out, fall badly. This is why early informed dialogues are definitely an essential. I'm going to walk you through three of the critical or most largely advertised and spoken about risks that we're seeing in last year and coming obviously into this year with the liability space in all forms of insurance. So PFAS contamination has made the news cycles multiple times for water contamination, and it's an expanding footprint of a forever chemical. It's not just a niche environmental issue, as many of you become aware. The chemical is everywhere. It's in manufacturing processes, lots of food handling, construction materials, waste operations, firefighting residue, imported goods, industrial coatings, and all sorts of waterproofing products that are used every day in consumer items. Many businesses simply don't realise how deeply PFAS is embedded in the supply chain and operations. And the tightening regulations that are coming into place or will be coming into place in the future need to be identified, monitored, and potential remediation steps looked at and containments put in place. This is an environmental issue that is going into a commercial one. So testing programs, assessment sites, product checks, supplier vetting all need to be uptaked because of this. And these costs are costs that unfortunately businesses will have to absorb, regardless of whether they've created the contamination or simply inherited it as legacy infrastructure is passed on. Insurers are responding as well. We're seeing consistent movement towards exclusion, endorsements, sublimits, and sometimes firm underwriting questions around PFAS. Legal cases emerging in Australia and overseas about how liability is interpreted on both sides. Brokers need to stay abreast of this, of how the claims are falling out, and have examples and understand where the regulatory shifts are occurring, so they're in a better position to understand and discuss this with their clients. For brokers, there's an opportunity here, because if you're proactive and educating clients about have they mapped out or seen where the possible exposures are in their operations or supply chain, have you carried out responsibility of testing or cleanup measures for your contractors, or do they have policies in place? Do you understand what the PFAS exclusion is and how it may apply to you? These conversations are things brokers need to have towards risk management for their clients, not just for broking a policy, but guiding a business through the regulation and complexity of operation day to day. The next big issue, which we've seen for years and years, continues to grow in momentum, is AI. And it's not just the large model language that we've seen previously, but it's an unseen liability for a lot of businesses. The adoption of AI is exploding from small to large business as a recruitment tool, customer service, decision-making, products design, analytics, automation, often without truly understanding where the liability sits or where the implications may fall. It is powerful and efficient, but it also leads to risk and creates new risk pathways. There's data bias, privacy breaches, inaccuracies, and misleading outputs, automation failures, over-reliance on unverified information often. These are all exposures that underwriters are already watching, and we may become, many AI systems use external vendors, and the questions around data ownership and accountability and governance are critical because there is some legislation that already impacts privacy, whether it's in Australia, the US, or Europe. Clients often believe that AI is just making things easier, and in some cases it does, but until something goes wrong, then there's no human oversight or testing or clear authority in place. AI can amplify an error if it's at scale, and the business relying on AI could have massive impacts for not just the customer, but their employees, their compliance, their safety, and their liabilities, and it is very real. This is where, as trusted advisors, you can step in and say, well, are you using AI in your day-to-day business? Who's accountable when things go wrong? Who's checking the data? Who's owning the data? Is it protected? How are you verifying the outputs? Are they checked? Helping clients understand and build good AI risk framework is part of your strategic risk partnership and governance that you can help them put in place. It's not just part of the insurance and not just something that an insurer can pick up, unfortunately. The third part is labour hire complexities, which many of you are already well and truly aware of, but there is increasing scrutiny and increasing exposures and shifting exposures that we've seen last year and will continue into this year. It's challenging for liability classes, and it will obviously lead to lots of disputes over responsibility. There's obviously contractual obligations that can be unclear, heightened regulatory expectations around duties of care, contributions of greater exposure and more frequency of coverage when it comes to coverage or pressure points. While some of you or most of you should be familiar with labour hire sources, third-party providers, internal labour hire agreements are increasingly more topical. In the last 5 years or so particularly, they've become a favourite of accountants to push onto businesses to try and reduce their workers' comp costs. And over the last 12 to 24 months, we've seen new entities pop up, particularly from Berkeley's side of things, to try and transfer the staff internally so that they do reduce their costs, but the costs aren't transferred, they're just shifted to the insurance. So the workers go from the original employer to the new employer that's basically just the contractor, and then they're contracted back to the original employer who's hiring them to save money on the workers' comp. Little do they know that the liability still sits with both businesses. There are multiple considerations and multiple cases of this. There are some savings up front in some ways, but it does avoid the enterprise bargaining agreements in some cases. There is governments signalling that they're wanting to stop this practice as well, and it is adding layers of uncertainty and scrutiny for a lot of people as well. For liability, it is shifting the recoveries from the workers' comp to public and products liability for the company hiring them back or the company that is employing them potentially. And this causes a lot of headaches because the workers' comp insurers are quite happy to dip their hands in the pockets of other people. The key issue is obviously this cross liability, and the insurers like to have someone, or the workers' comp insurers do pursue recoveries and are very vicious, particularly in New South Wales and certain other states, in seeking recoveries with lots of frequency. There's disclosure issues as well, because sometimes you as brokers aren't told, and us as underwriters don't have it declared to us either. So it is important to have this discussion around labour hire or internal labour hire. It is a practice that obviously needs to be made aware of to the client, that it can cost extra because it is an impact on the insurance. And if it's not properly disclosed, it can cause issues come a claim. From an underwriter perspective, it is always assessed on a case-to-case basis, but a lack of clarity, incomplete documentation, or non-disclosure can materially affect all insurers' appetites, and in some cases prevent an placements entirely. When it's a higher risk, particularly a blue-collar risk, there's very high and large and unpredictable recovery costs in the liability space, which isn't acceptable for most insurers. To protect your clients and to avoid nasty surprises come claim time, all brokers should be having the discussion about labour hire, internal labour hire, and group employment methods and structures. Who controls the day-to-day work, who's supervising who's training who's providing the equipment and PPE or systems of work. Are there proper documentations, organisational charts and systems? Do contractual indemnities align with the insurance? Are responsibilities clearly documented? Is there any grey areas that leave either party exposed? Has the indemnity insurer also been notified of this issue and yourselves? Red flags we like to consider newly created employment entities, new ABNs for payroll purposes, declarations stating no labour hire when there's multiple entities and groups, internal service agreements that are generic, unsigned, or silent on whose work health and safety responsibilities should be in place. They do look commercially attractive on paper, the internal labour hire, but they can shift and amplify liability exposures, particularly with the workers' compensation recoveries and cross liabilities. If not properly declared, underwritten, the results can be coverage disputes, reduced claims outcomes, and uninsured recovery. When they're fully undeclared, the client could expect significant premium and excess impacts, and in some cases, genuine placement difficulties. These conversations aren't reactive, they're essential early discussions to clarify the ownership of the business and where before claims occur, so that the insureds are well prepared, and yourselves too. The claims and repercussions in underwriting. So we've got an example for you here. The insured is a group of operating a recycling facility. The group of companies, it has a holding group, has a operations group that conducts the business day to day, and a HR company which sits underneath it. Now, the plaintiff in this situation was employed by the HR group as a supervisor, and all his work was conducted for the operations group, i.e. under an internal labour hire agreement. The plaintiff sustained a crushing injury to his hand when he was assisting another worker to pick up a bag of granules using a forklift. He looped one bag handle over the tithe, so the prongs that stick out of the forklift, and as he did so, the other slid down, resulting in his hand being crushed on the tithe of the forklift. The HR company, or the employer that was prosecuted for the Work Health and Safety Regulations breach, for the Occupational Health and Safety Act, for failing to provide a safe work environment and failing to provide proper instructions and training to the employee. The regulator's investigation revealed the forklift had not been properly maintained, leading to accumulations of debris around the tyres, and which prevented the locking pins on the tyres from operating properly. They pled guilty to 2 charges. The plaintiff's hand was very seriously and complicated with post-traumatic arthrofibrosis, which is excessive scar tissue in and around the joints, resulting in limited motion in his fingers post the accident, and complex regional pain syndrome. The plaintiff was in his late 40s at the time of the incident. He had very limited education and had only completed grade 4 and had English as a second language. There was limited prospects for him for work in the future, so the plaintiff made a workers' comp claim which was accepted. The plaintiff commenced a common law claim against the employer and the operations company as well. The quantum was over $1 million plus costs. The workers' compensation insurer also commenced a statutory recovery claim against the operations company of $500,000 plus costs. So there's already $1.5 million plus costs. So that's all the other legal fees. The employer, the HR company, was indemnified by the workers' comp insurer under its workers' compensation policy. The operations company sought indemnification under its public and products liability policy, which was issued by us. The total amount we paid to the operations company to settle the claim was around the $1 million mark. This has become a common arrangement, and the broker and insurer alike needed to be aware of the ramifications. So the cost for that claim itself was over $1 million. Berkeley, just on the liability side of stuff, has paid over $1 million. As you can see, quite an expensive exercise, and obviously the insured needs to be well aware of what's going on and going forward. So yeah, this is some more emerging trends to watch, probably some stuff you're aware of, but things that obviously need to be highlighted as they become bigger issues to consider going forward this year. Three big issues to consider are the microplastics, which some people may be aware of. Larger plastics basically degrade, break down, become smaller than 5 millimeters. Usually it's clothes, bottles, plastic bags, wrapping, anything like that, industrial processes, cosmetics, all sorts of things can come in. It goes in the ocean, rivers, food, soil, air. They don't degrade, they usually accumulate. There's lots of research into the impacts on health and things, but it's still ongoing. There's a lot of cleanup and other work trying to happen, but it's still long ways to go. The impact is obviously health impacts, short to long term, we're unsure. It's like PFAS or asbestos, potentially. It could have quite a serious impact on people's health long term. There's a regulatory shift to this as well, toughening on the microplastic situation to make sure people are compliant or clean up, or they withdraw products. So we've seen the plastic bags removed from shelves in the last few years in most states in Australia. Again, growth of environmental liability claims also for waterways and soil due to pollution, which can be trigger pollution exclusions on some policies as well. Products liability for manufacturers as well and distribution due to certain microplastics can happen. Risk and opportunity, obviously, for recyclers and innovators to work on ways to recover and speed up the removal of this sort of scourge that it is. We've seen, obviously, this last year or so with changes in global leadership, that politics and geopolitics has changed significantly. Even the last 2 weeks with Davos, the World Economic Forum, there's a huge shift in geopolitical and trade and international relationships. It's obviously changing some government policies There's been a huge rise in nationalism in the last 5 years and protectionism. There's diplomatic tensions all over the world and lots of conflicts, whether it's over a particular country or just the ongoing conflicts we're well aware of. This does disrupt global supply chains and can cause things, whether it's in the South China Sea or in other areas of the world. And obviously this can impact insureds, costs and everything else. It does delay goods. It does cause product quality sometimes to vary. And obviously it can mean that we need to look at, your insureds would need to look at its supply chain or substitution, which can affect cost. I haven't heard too many contract disputes, but I'm sure they probably would be. Increasing compliance requirements potentially, as well as we get sanctions come in and out. Increasing compliance requirements, as well as you monitor those changes, higher costs of operation and interruption potential. And obviously there's physical loss possibilities if things are seized, like oil tankers that are in the open ocean. As we see this, there's obviously impacts on insurance. So the volatility does impact defects, contamination, products, with higher exposure to these international crises and volatilities. Greater likelihood of contractual disputes due to delays or non-performance may trigger liabilities, especially indemnity, if indemnities are vague. Sometimes underwriters do have to scrutinise if insurers do need clearer information on sourcing or geopolitical exposures in supply chain and control. There are possible exclusions and sublimits on some markets because of these things, with the political instability in regions and the suppliers that are coming from them. To shift gears slightly, the robotics and automation of processes. Obviously, this is something that's been happening since I was a kid, so over 30 years. We're seeing it uptake significantly now, though, with the labour costs in Australia. And it does mean that not just robot arms, but full automated warehouses, self-driving machinery and automated vehicles, AI-driven production lines, and sensor integration has gone through the roof. It does reduce manual labour, human injury risks, but it can lead to additional exposures of software failures, system malfunctions, large-scale production defects if something isn't picked up. We're also seeing impacts on insurance coverage, shifting from the bodily injury to technology-driven liability, where there's system error or system failures, the primary cause of loss. There's recall issues around if there's a defect that isn't picked up or the system doesn't deem it a defect. The professional liability exposure as well, when the highly skilled oversight is replaced by automated and the error is exacerbated. There's also contemplative automative losses, and if things aren't maintained well or other things aren't looked after, it can cause further issues, which leads into the next one as well. So you can see it there, lithium batteries and hazardous storage. We've seen a range of fires in the last few years from lithium batteries and other hazardous items being stored improperly or looked after properly. Obviously, lithium batteries are great. They power lots of things, but if they're not looked after and not stored well, they do have a huge potential for fire, explosions, and toxic smoke. The costs for cleanup are very high. There's specialist storage requirements. They're hard to put out. Like with other chemicals, they can have overheats or ignition, and then very, very difficult for them to deal with or clean up, or even just deal with the recycling of those that are damaged but aren't part of the initial fire or explosion or something like that. We've seen loss of life as a result of this, and obviously it is something that we as underwriters do take seriously and are aware of. The environmental exposures, obviously, for this are something we are aware of and may trigger most pollution exclusions. There are tightening transport and storage requirements. If you order things off Amazon now, they come with a nice little label if they've got the batteries on them, saying that they've got the lithium batteries in them, or they should. There's stricter coverage limits around most policies. So that's obviously good things, and there's obviously limitations as well with hazardous goods around regulation and the regulatory standards. I hope I didn't move too fast, but there was a bit to cover. I'm happy to talk at length if anyone else needs to, but all of these themes are moving fast, like I did, and they're obviously things that have moved a lot quicker than most businesses realised and most are aware of because they're busy getting on with their business. You as risk advisors obviously need to start having these discussions so that they understand that they could have impact on the client's pricing and coverage and claims outcomes. We want to add value in 2026, so starting the conversations early, uncovering hidden exposures and guiding clients to emerging risks before they could become a cost or compliance problem or a claim would be amazing. And like I said before, the good example of the lithium battery is we've had one product claim for our own. There was a battery in a couch for a cup warmer, and the battery caught fire and proceeded to burn the whole house down, which was quite a significant loss. And this is just one example of what we see the batteries as a risk of, let alone the rise of an EV battery or something along those lines. So turning a risk into an opportunity, we talk about all of these things from PFAS, AI, labour hire models, cyber dependency, microplastics, lithium batteries, robotics. It's easy to see lots of problems waiting to happen, but for you guys as brokers, there's many opportunities in relationships. Education is built with builds trust, and trust builds loyalty. So to educate effectively, we must stay ahead of the information curve. Encourage your team and clients to lean on our new CPD sessions or insurer-led insights. Clients value brokers who invest in staying informed. The better you understand these risks and the more confident and credible you become to your client's conversation, the more you can add. Emerging risks highlight gaps in process, coverage, and sometimes in clients' assumptions, but gaps are not problems. Gaps are opportunities. These allow you to position new products, and endorsements or sublimits you can be aware of, and allows you to position environmental liability, cyber cover, specialty liability, or professional lines as tangible solutions. Clients can see enormous value that you don't just ask to identify a risk, you bring them a solution as well. It shifts you from perceived as a policy provider to a trusted advisor. So accountability, environmental and pollution exposures, labour hire and contract structures, tech-driven system failures, supply chain triggered liabilities, all things to be aware of. These risks sit in a grey zone of liability, and clients are often unsure where the risks start and where their policy responds. Your role is to simplify the complexity and translate what's covered, what isn't, where the risk sits operationally, and what they can do to get ahead of it. When you remove confusion, you elevate your value instantly. If you raise these risks before they show up as an exclusion, rate increase, or a customer complaint, or supply chain failures, you demonstrate a level of foresight clients rarely see. Clients remember brokers who help avoid the loss, secure coverage before the market tightens, point out regulatory changes early, recommend an extension before the claim happens, not just the broker who processes the renewal. When you move from asking what policies do you need, here's the risk strategy for the next 12 months, you become indispensable and unchangeable. Your competitive advantage for 2026 won't just come from price or placement. It will come from insight, foresight, and the conversations you lead before anyone else does. Thank you.
Hello. Could we all hear Matt, or did we all lose our sound for a little bit there? Yeah, we did. So I was just chatting to Chelsea, and some of the internet in the Sydney office is going in and out. So we can see your your questions and your comments. So if you can't hear me, it's because I'm driving through a tunnel, but you can probably just pop something in there, as Jules did 3 minutes ago and got 19 likes. I can also see that we've got quite a few questions about the internal labour hire, and also there's one about the microplastics. We might come back to those later. I think a few of them are quite specific, like we'd have to get into some of them with our claims team, but we will be coming back to you, and we can send that out to everybody if they're interested. So what I'm going to be talking about is how to stay relevant in 2026. So it's moving on from what Matt said. So the market is shifting. Clients are expecting more, and insurers are becoming increasingly selective, not just on pricing, but on risk quality, transparency, governance, evidence of controls. So the real question is, how can you stay relevant and valuable in this kind of environment? First, become an insight holder. Clients no longer want someone who just gets quotes. As Matt said, that's the bare minimum. So what they value now is a broker who brings insights, trends, and claims intelligence. When you can explain what's changing in the market and what it means for their business specifically, you move from being a transaction manager to a trusted advisor. And that shift is powerful. It drives retention, strengthens relationships, and creates growth through credibility. So use what you're seeing in the claims trends, industry shifts, and underwriting appetite to help clients understand what risks are increasing, what insurers are tightening around, where the market is becoming less forgiving, and what proactive steps will improve outcomes. Second, introduce emerging risk conversations early. If you're the first person explaining PFAS, AI driven risk, or labour hire exposures before the client experiences an issue, you immediately differentiate yourself. You can send a clear message: I'm not just responding to issues, I'm helping you avoid them. That proactive approach is what today's clients really remember. Third, use strategy, not just placement. This means offering things like quarterly risk reviews, helping clients map out changes in their exposures, and simplifying complex regulatory shifts so they can make informed decisions. These activities build deeper trust because they show you're managing risks over time, not just arranging insurance once a year. Fourth, make claims prevention part of your service. Every emerging risk brings new claims pathways, and insurers are watching loss drivers closely. The brokers who stay relevant won't only help after a loss, they'll help clients reduce the chance of the loss occurring in the first place by offering practical guidance like contract and indemnity red flags, supplier and quality assurance controls, incident response preparation, basic cyber hygiene, and governance. storage segregation, and compliance measures for hazardous exposures. Clients remember the broker who helped them avoid pain, not just the one who helped them recover from it. Start renewal earlier and manage the process proactively. Admittedly, I feel like most of you guys really do love to start renewals early. I was kind of doing some March renewals in December, so you're on trend for 2026. Renewals are increasingly complex and insurer scrutiny is heavier. Late submissions and incomplete information now have a cost. Reduced options, increased premiums, tighter terms. Relevance means you're the broker who starts early, anticipates insurer questions, helps fix weak spots before the renewal conversation, and protects the client from last-minute surprises. This doesn't just improve outcomes, it reinforces your value every step of the way. 6, build a network of specialists and bring them into the conversation. Emerging risks often sit outside pure insurance knowledge. Clients benefit when brokers can connect with them with the right expertise: cyber consultants, environmental specialists, workplace health and safety experts, legal advisors, and supply chain reviewers. When you bring specialists to the table, you're no longer just the broker. You become the organizer, the person who helps solve the problem and not just insure the problem. This is the defining change. When you move the conversation from what policy do you need to here's your risk strategy for the next 12 months, you stop being interchangeable. As the broker, that's where the advantage sits in 2026, not just in the placement, but in the insight and the conversations. Enhancing submission quality and speed. Now let's talk about submission quality, because in 2026, it's more critical than ever. Underwriter scrutiny is high, capacity is selective, and only the strongest submissions get the fastest attention and favorable terms because of the context that they provide. The first thing underwriters look for is a clear risk narrative, because forms alone don't tell a story. We want context, controls, improvements, the why and the how. A strong risk narrative explores what the client actually does. This is very key. Sometimes it's not clear. What controls they have in place and what improvements they've made, especially if there's been like a structural change in a company or if there's been a claim. A well-crafted submission can turn an average risk into a strong risk and a strong risk into an exceptional risk. 99% of the time, insureds will either use too many words or not enough words to describe what they do. They often sound overcomplicated and do not actually specify their tasks and responsibilities. So it's always a good idea to provide a list of day-to-day tasks and responsibilities of what they do. Providing a detailed business description ensures that the client is correctly covered for the activities they are actually undertaking and can also ensure that they are insured for the correct product. For example, an engineer project manager can be written on either like a PI construction wording, or it could also be written on a D&C wording, but it would depend on their responsibilities and a few additional questions. And that's where the details matter. So how we would ask those additional questions would actually come into addendums, and these are critical. So we have specific industry wordings like accounting, recruitment consultants, engineers, just to name a few. Having the client complete an addendum will ensure that the underwriter has the best chance of providing correct and competitive terms. Another way to nail down on the specifics is to provide a CV or a resume. A list of qualifications or how long the client has been in business is an excellent indicator of their experience. And if we would consider writing the business, we look upon individuals with experience when starting their business a lot more favorably than someone who has just become qualified and never worked in the industry. Finally, another great tip is to include a website. I find this particularly helpful for IT risks. If an IT consultant doesn't have a website, that's a bit of a red flag. Also, websites are helpful for risk appetites. With IT risk particularly, they always tend to sound very fancy and they have like ships of rockets on their homepage. So it really kind of helps to nail down what they actually do and what industries they work in. A strong submission will also address claims history. Whether it's a new business opportunity or a renewal, underwriters don't just want to know what went wrong, they want to know the risk mitigation steps. Like, what have you put in place now to help this further? So we would need to know what caused the previous claim or claims, what controls or processes have been implemented since, what behavioural, procedural or operational changes have been made, and the changes that reduce the likelihood of reoccurrence. You know your client's claims experience better than anyone. Tell the underwriter what the client has proactively done to improve their profile and why they are now a stronger risk to retain. This is one of the most persuasive components of a submission, especially in tougher markets. Complete information matters more than ever. Missing details can create delays with the back and forth for additional information. Complete submissions can rise to the top of the queue and can ensure a better underwriting results and turnaround times. Identify key red flags early, especially around high-risk areas like mining, oil, gas, PFAS, AI exposures, and those internal labour hire risks, or just labour hire risks. If you surface the issue upfront and explain how it's controlled, the submission is viewed much more favourably. Clearly document how the client mitigates the risk, including controls added after past claims. The more confidence an underwriter has of the client's controls, the better the pricing and the stronger the terms and smoother the placement. Proactive communication builds trust. Underwriters want visibility on what's changing for the client. What's new, what's improved, what controls have been in place, what structure changes have happened, and what's coming up in the next 12 months. Renewals should never bring surprises. Proactive communication strengthens trust and deepens insurer relationships. A thoughtful and detailed submission can genuinely be the difference between receiving a quote and receiving a decline. Every piece of context strengthens the underwriter's confidence and strengthens your relationship with them. When you elevate submission quality, clarity, completeness, context, and claim-driven improvements, you're not just improving outcomes, you're strengthening long-term insurer partnerships. And in a selective 2026 market, that partnership is one of the most powerful competitive advantages. So now we're going to move on to how to reduce referrals. So pretty much every insurer or agency has an online portal these days. I'm going to specifically mention a few points to keep in mind when using our portals, which is either SCTP or Bind It. So when using the online portals, attaching a proposal form or including any additional comments will always cause the quote to refer. We need to ensure that the proposal form and information match the information that was already entered and that we're happy to offer terms. So obviously, if you provide any additional information, we would need to read, review, and accept it or decline it. So if it's like more of a risk that you're happy with and the proposal form literally matches what you've entered in, there's no need to attach a proposal form. Another referral trigger is amending the business activities where you're able to override the business description. This will always refer, as we will need to ensure that we are comfortable picking up the risk noted, because we need to also make sure that they match, because sometimes people write in consultant and then they're a structural engineer. So we just need to make sure that matches. We wouldn't want to be covering, things like that. With this in mind, if you would like a very detailed business description, this can be transacted on the portal, but you would need to be mindful that it will refer each time. I do have a broker that we do this with. He knows it's going to refer and he likes to write in a full business description, and I'll get back to him, by the end of the day. An occupation code that will always refer is other, because other appears as well. This is mostly an ML situation. So ML is different to PI. Because in ML, we don't require a business description per se, we require the best fit industry. A lot of times a risk will refer because the broker enters other and then a long business description. For ML, we just require the industry that the insured works in for the majority of the business. Again, if you're unsure or you are a bit concerned about making a mistake or entering in something wrong, you can always give us a call. That's where the building relationships really comes back in. Another one is if you select any optional extensions. This will refer as we'll need to confirm we're happy to provide the cover, and we may need additional information in order to offer that. Underwriting considerations is a big one. So this is where quotes refer due to information needing to be reviewed in respect to our guidelines. For example, claims, the percentage of contractor or labour hire payments to wages, or the percentage of a total activity, like off the plan sales, for example. We will need to review the information and come back to you. It's important to note here that when you're communicating with you about an online risk, we will converse with you through the SCTP or the Blind It portal. This ensures that all the communication is stored in the same place. Many risks on the, just important to note, many risks on the portal do not refer. I got confirmation today from the our internal Blind It team that only 43% of quotes actually refer, so all the others go through. So we move on to the importance of building relationships with that pretty little picture. In a selective and fast-moving market, relationships with insurers are one of the biggest competitive advantages. Good underwriting outcomes don't just come from strong submissions, they also come from strong relationships. One of the most underrated tools is simply picking up the phone. A conversation builds rapport faster than an email. Phone calls can create a space for nuance, context, questions, and real-time problem solving. Underwriters remember the brokers who communicate well and who made their lives easier. Emails are still very important, and they will need to be clear, complete, and timely. A well-structured email signals to an underwriter that you are organized, you're thorough, and you're someone they can rely on. And when an email updates them before they have to chase you, that builds trust. In-person meetings can deepen the relationship even further. When underwriters understand your style, your clients, and the way you approach risk, it changes the dynamic completely. You stop being just another inbox and you become someone they can genuinely want to work with. We're also happy to go out and meet your insureds if required as well. We can arrange that. Events and informal social time play a big role. I think everyone's pretty good at that one. These settings allow for authentic relationship building, the kind that makes future conversations easier and more collaborative. When the relationship is strong, the dialogue is more open, and the outcomes are usually better. But the real test of an insurer relationship is claims. Claims works best when brokers are notified early, and insureds are far more likely to notify early when they trust you and feel supported. When you, as the broker, are involved from the start, you can guide the client and manage expectations and work with the insurer to get the best outcome. Early notification combined with strong insurer relationships leads to quicker decisions and smoother claims handling. At the end of the day, relationship building isn't optional, it's strategic. It helps your clients, it helps your insurers, and it elevates you as a broker. The stronger the relationship, the stronger the results. Okay, so Slido time, if you're still hanging in there with us. We love these because they give us a direct insight from you. Your input here will help highlight the pain points you're facing and show us as insurers where we need to step up. So what was your biggest pain point when working with insurers in 2025? Now, this doesn't have to be specifically Berkeley, because you love us, obviously.
It's definitely not about Berkeley.
It's definitely not about Berkeley.
So we'll just wait for the page to set in, and question 2, there should be more options. I'm hoping other people can see more than 2 options to select from. Yeah, there's only 2 options showing, unfortunately. So I'd be really appreciated if at the end of this, with the Q&As, please put these into your responses after the webinar finishes, and then we can definitely take that into consideration. Unfortunately, there seems to be a bit of a tech issue with the Slido. So as we're wrapping up anyway, since we've got 5 minutes to go, I'll move on over to any questions, which I have noticed that they are being answered through through the actual WebEx webinar. Any of the questions that we don't get answered, we will respond to you via underwriter Berkeley contact. So please jump on now with any questions that you have so we can definitely come back to you. I'll just quickly move over to our Broker Learning Hub slide. Basically, the last 2 slides are highlighting our key educational offerings. If today's webinars sparked your interest regarding more in-depth training, please jump onto our website where you can book sessions directly through our Learning Hub. All the courses include CPD and CIP points and can be delivered virtually or in person and can be tailored to suit your team's specific needs. With the webinars that we have coming up in this slide, every month we will have a new webinar that you can log on to. So please watch out for our upcoming marketing invitations or head to our website now to secure your spot. Thank you very much for spending your afternoon with us today, and we hope you're walking away with some valuable insights that you can apply immediately in your conversations with your clients as well as with the insurers. Hope you enjoy the rest of your afternoon. Thank you.